Welcome to the weekend edition of the Fear and Greed Business Headlines, the week that was, a wrap of the biggest stories over the past week. I'm Sean Aylmer. It was the week of the federal budget, share market highs and lows, cryptocurrency craziness and corporate intrigue. Let's start with the federal budget. It dominated the news agenda, even if much of the population wasn't really that interested. Federal Treasurer Josh Frydenberg outlined a big spending budget with tax breaks for business and individuals, and a goal of creating 250,000 new jobs by the end of next year. There was spending in aged care, spending in healthcare, money for a new coal-fired power station, money for roads, money for rail, for women and for housing. There wasn't much for the travel and tourism sectors, nor much in terms of retirement savings plans. But all the largesse from lower unemployment and booming iron ore prices was spent, and that will leave a massive debt for future generations. What the budget did was set the ground rules for the next 12 months or so of electioneering, ahead of the next federal poll. The spending binge alongside low interest rates must make it very tempting for ScoMo and crowd to think about moving on with an election. In non-budget economic news, both business conditions and confidence hit all-time highs this month, dampening fears of a fiscal cliff resulting from the end of JobKeeper back in March. Trading, profitability and employment readings in the National Australia Bank survey were all at new highs. NAB chief economist Alan Oster called the result simply stunning. It was a good news week on the COVID front. While there were 2 community-transmitted cases in New South Wales and 1 in Victoria over the past 10 days, and New South Wales went into a short, partial lockdown, there hasn't been any since. The vaccine rollout continued with around 3 million jabs now having been given. Meanwhile, the government has secured 25 million doses of the Moderna vaccination, 10 million of which will arrive this year. Some pretty worrying developments overseas during the week, particularly in the Middle East. Militant group Hamas and Israel are firing rockets at each other in the Gaza, and there are skirmishes between Arabs and Israelis in other cities. The number of dead is climbing quickly, and the United Nations and US President Joe Biden have expressed concerns. There was surprising economic news out of the United States. First, payroll figures were disappointing in the world's biggest economy, suggesting government spending would have to continue. Then inflation figures showed a multi-decade surge in price rises, which triggered a sell-off in share markets and a jump in the US dollar. Across the Atlantic, the European Union upgraded its economic forecast for the region, saying it expected it to expand at a 4.3% clip this year and a touch higher next year. The Scottish National Parliament won the election in that country, and it's now heading to another referendum on breaking away from Britain. All this action impacted financial markets. More on equity markets later in the podcast, but it was quite a week for the Aussie dollar. It was buffeted by higher commodity prices and fears of increased interest rates in the US. By the end of the week, it was trading well down on a week earlier. Gold prices should have risen more given the US inflation figures that came out, but they were pretty steady all week. Iron ore prices soared to a new record level before coming off. The big miners, BHP, Fortescue Metals and Rio Tinto, all went along for the ride. Unfortunately, I can't get through the week without mentioning cryptocurrencies and Mr. Elon Musk. Dogecoin, the cryptocurrency that started as a joke based on a meme and is now the 4th largest currency of its type, surged after Mr. Musk tweeted about whether his company Tesla should accept it for payments. 750,000 people responded to his question within about 30 minutes, pushing Dogecoin 17% higher. Then, a couple of days later, he said Tesla wouldn't accept Bitcoin for vehicle purchases, reverse ferreting his position announced 5 weeks ago. Bitcoin's value tumbled. I get that cryptocurrencies make trade easier. I get that some, like Ethereum, are based on a platform, which is a real asset, but I do not get why they are valued so highly. Corporate news this week was plentiful, when isn't it? Woolworths outlined its plans to list its liquor and gaming business in a $10 billion float. It will be called the Endeavour Group and be 15% owned by Woolworths, 15% by the Bruce Matheson Group, and the rest by shareholders, mostly Woolly shareholders to begin with at least. It will include Dan Murphy's, BWS, 332 licensed venues, and more than 12,000 poker machines. That's a lot of pokies. Expected to hit the bourse around the middle of the year. Commonwealth Bank reported a bumper March quarter cash profit of $2.4 billion on the back of a surge in business lending. The bottom line was almost twice as good as last year, and investors are hoping the bank may return capital to shareholders in coming months. This could be via a special dividend or perhaps a share buyback program. Qantas boss Alan Joyce started the week by warning against Australia becoming a hermit state by keeping its borders closed for too long. But as the week rolled on, the government made it clear that it wasn't so sure that people would have received a COVID jab this year, and it became clear that a return to normality, at least in terms of international flying, won't happen until the middle of next year. Kerry Stokes' Seven Group Holdings made a somewhat opportunistic $8 billion bid for Boral, which was immediately rejected by the building materials company's board. There was no premium in the bid, but it will probably allow Seven Group to increase the number of shares it holds above its current level of 23%. Treasury Wines, owner of Penfolds, said it wanted its flagship product to be more of a luxury brand like Mercedes, Hennessy and Gucci. It was a little confusing for me. I thought it already was. Or does everyone normally buy Grange with their weekly shop? Anyway, it emerged that Penfolds accounts for about 2/3 of the group's earnings. That news sent Treasury share price higher. Car Sales spent $900 million on an online marketplace in the US for niche vehicle markets, including RVs, think grey nomads there, and industrial vehicles. Building materials group CSR said there was plenty of demand for new houses, and that was causing shortages of brickies and roof tilers, as well as timber roofing frames. The A2 Milk Company downgraded its outlook because the Daigou channel to market remains closed. In one session, its share price fell 13%, and it's down 2/3 over the past year. Fertilizer group Incitec Pivot also downgraded its outlook on the back of problems at a factory in Louisiana. Its share price fell 9%, but the big daddy of share price falls for the week came from mining services group Perenti Global. It said it was being buffeted by the higher Aussie dollar, higher wages, and the pandemic, and its share price fell 28% in one session. It rebounded, but nothing like what it had lost. And there were reports in the Chinese media that Beijing had told two importers to stop buying Australian LNG. If true, it would be yet another escalation of trade tensions between Beijing and Canberra. Now I get to the point in the program where I go through the biggest story of the week, the sleeper story, the most remarkable story, and my favourite story. The biggest news story of the week was equity markets. The S&P ASX 200 hit a new high on Monday afternoon, closing at 7,173 points, beating the high set back in February 2020. It was up more than 2% in a week. And then things turned. News out of the US on inflation, ongoing cases of COVID-19 around the world, and nervousness about how hard the market had run all led to falls on the local market. But the biggest declines came from the tech stocks. One-time market darlings Afterpay and Zipco, both buy now, pay later businesses, are down 30% or so in the past month. Cloud accounting group Xero tumbled on a lack of future growth prospects. And it wasn't just in Australia. Tech stocks around the globe have fallen sharply. The tech-heavy Taiwanese market tumbled 9%, the biggest drop in its 54-year history on Wednesday. The Nasdaq on Wall Street tumbled early in the week, though it did claw back in final sessions. This week may well mark the end of the tech boom, and that's why it was the biggest story of the week. The sleeper story of the week involves housing. The number of available rental properties across the country has fallen to its lowest level in almost a decade, according to data group SQM Research. So, this should mean that rents jump sharply. The exception was inner cities Sydney and Melbourne, where there's a lack of international students. Then last weekend, the heat in the auction market just came off a bit, and people are definitely more worried about rising interest rates. I'm not quite calling an end to the housing boom, but all these anecdotal indicators are worth watching. The most remarkable story this week was a tussle for Crown Resorts. Arch-rival Star Entertainment Group launched a merger proposal to join the two, bringing together casinos in Victoria, Western Australia, Queensland and New South Wales. Star said the bid was worth about $14 a share, but it was convoluted. It involved cash and shares and included about $2 billion in value, which depended on a merged entity achieving cost savings. The alternate bid is from private equity group Blackstone, which upped its offer to $12.35 a share. At least that's all cash and much simpler to understand. Crown shares finished the week above Blackstone's offer, but nowhere near Star's extrapolated price. Also by the end of the week, Crown had agreed to undertakings with the New South Wales gaming regulator, taking a step closer to receiving a casino licence. This whole Crown Resort saga is remarkable this week, but it's been remarkable all year. And my favourite story this week involved the largest refined fuel pipeline in the US. The Colonial Pipeline that pushed fuel 5,500 miles up and down the East Coast was cyber-hacked. The flow stopped and a ransom was demanded. The perpetrators put out a note saying they were sorry for the disruption, but just wanted money. Honour among criminals or something like that. Bloomberg reported that the owners of the pipeline paid $5 million, but the decryption software didn't work quickly enough. Eventually, the pipeline started working again after backup systems were invoked. So, we have cyber hackers apologising, big business paying, the solution not working, and fear about fuel shortages spreading far and wide. Who wouldn't love a story like that? That's why it's my favourite story of the week. Whew, that's it. That's the week in review. It's been busy with budgets and takeovers and things, but how much fun's it been? I'm Sean Aylmer. I'll be back on Monday morning with the Fear and Greed business headlines. I look forward to your company then.